Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months. Inflation has moved up and is elevated, in part reflecting the recent increase in global energy prices. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. Developments in the Middle East are contributing to a high level of uncertainty about the economic outlook, and we will remain attentive to risks to both sides of our dual mandate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand at a brisk pace. In contrast, activity in the housing sector has remained weak. In the labor market, the unemployment rate was 4.3% in March and has changed little in recent months. Job gains have remained low. A good part of the slowing in the pace of the job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. Inflation has moved up recently and is elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 3.5% over the 12 months ending in March, boosted by the significant rise in global oil prices that has resulted from the conflict in the Middle East. Excluding the volatile food and energy categories, core PCE prices rose 3.2% over the 12 months ending in March. This relatively high rate largely reflects the effects of tariffs on prices in the goods sector. Near-term measures of inflation expectations have risen this year, likely because of the substantial rise in oil prices. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. The economic outlook remains highly uncertain, and the conflict
Sorry about the delay.
has added to this uncertainty. In the near
Shout out
term,
Jerome
higher
Powell.
energy prices will
Let's
push
go.
up overall inflation. Beyond that, the scope and duration of potential effects on the economy remain unclear, as does the future course of the conflict itself. We will continue to monitor
doing
the
research
risks
right
to
now.
both sides of our dual mandate.
Hold up.
We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. This is my last press conference as chair, and I will close with a few thoughts. First, I want to congratulate Kevin Warsh on his advancement out of the Senate Banking Committee this morning. This is an important step forward, and I wish him well as that process continues. The Federal Reserve exists for one fundamental purpose: to foster the economic conditions in which American families and businesses can thrive. Stable prices, a strong job market, and a
Shout out to
financial
Kevin
system
Warsh.
they
You
can
gotta
depend
say
on.
that. You gotta say that, bro. You
Every
can't hate on
decision we
him.
make, whether about interest rates or regulatory and supervisory matters or other issues, is made in service of that purpose. Our decisions reflect the collective judgment of the Board of Governors and the Federal Open Market Committee, colleagues who demonstrate analytical rigor, principled judgment, and a genuine commitment to the public interest. Our collaborative and deliberative process has long reflected a shared commitment to finding common ground in service to our mission. This institution is resilient, capable, and staffed by professionals of extraordinary talent and exceptional dedication. It has been a privilege to serve alongside so many great public servants at the Board of Governors and around the Federal Reserve System. The Fed's work is only as effective as the public's understanding of it, and you, the press, are essential to keeping the public informed about what we do and why. The people we serve benefit from your careful reporting. I welcomed the announcement last Friday by the U.S. Attorney for the District of Columbia that she had closed the criminal investigation. She also noted, however, that she would not hesitate to restart the investigation. Over the weekend, the Department of Justice provided assurances that they will not reopen the investigation unless there's a criminal referral from the Fed's Inspector General. And, absent such a referral, if they do appeal the recent court decision, they would not seek, as part of that appeal, to restart the investigation or send new subpoenas. I've said that I will not leave the board until this investigation is well and truly over with transparency and finality, and I stand by that. I'm encouraged by recent developments, and I'm watching the remaining steps in this process carefully. My decisions on these matters will continue to be guided entirely by what I believe is in the best interest of the institution and the people we serve. After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor. There's only ever one chair of the Federal Reserve Board. When Kevin Warsh is confirmed and sworn in, he will be that chair. Once sworn in as board chair, his new colleagues will elect him to chair the FOMC as well. As I regularly point out from this podium, our success in delivering our goals matters for all Americans. I'm confident that the Fed will continue to do its work with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you, Mr. Chair. Appreciate the kind words about the press. Often doesn't come
Shout out
from
to
the
the
podium
Powell
in different
pivot.
places, but appreciate that. Can you talk about what
The man behind the chair.
gone into your decision to remain on the board? What kind of criteria are you
Fed
weighing,
chair.
and how long might you stay? Thank you.
Sure. So, my
Transitory
concern
inflation,
is
transitory
really
rate
about
cuts.
the series of legal attacks on the Fed,
It's
which
judgment
threaten
time.
our ability to conduct monetary policy without considering political factors. And I want to note here, this has nothing whatever to do with verbal criticism by elected
Q&A
officials.
already?
I've never suggested that such verbal criticism is a problem, and neither has anyone else here. But these legal actions by the administration are unprecedented in our
We
113-year
don't want to be a
history,
banana republic.
and there are ongoing
Come on now.
threats of additional
Shout out
such
Janet
actions.
Yellen.
I worry that these attacks are battering the institution and putting at risk the thing that really matters to the public, which is the ability to conduct monetary policy without taking into consideration political factors. It is so important for our economy, for the people that we serve, that they can depend over time on a central bank that operates that way, free of political influence. It's part of the absolute foundation of this amazing economy that we have. It's just one of the many reasons why the U.S. economy is the envy of the world. That piece of institutional architecture separates successful countries from unsuccessful countries. It is extremely important, not for the people who work at the Fed at any given time, but for the people that we serve,
U.S.
that the Fed
economy is the
remain
envy
able
of
to
the
conduct
world,
monetary policy in a
Jerome.
way that doesn't get pulled into politics, trying to help or hurt any particular politician or political party. It's critical for the people that we serve. In terms of when I would leave, I will leave when I think it's appropriate to do so. Was that all your questions, or was there?
Well, I just have a follow-up, which is, what would you say to the criticism that by remaining on the board, you're actually taking a political act and denying President Trump the majority of the board, which as president he would have if you left?
I don't see that at all. As I mentioned, I'm literally staying because of the actions that have been taken. I had long planned to be retiring, and the things that have happened in the last 3 months have, I think, left me no choice but to stay until I see them through at least that long. In addition, I don't see how this will interfere. My intention is not to interfere. I was a governor for almost 6 years, and the tradition is at the Fed that governors who understand how difficult the role of chair is, and as a soon-to-be former chair, I do understand how hard it is to get consensus with 19 strong-minded people. You work with the chair. You try to be heard, but also collaborate with the chair and try to support the chair when you can. When you can't, you can't. And I think that's the attitude that people generally take, and that's the attitude that I'll take.
Nick. Chair Powell, if I could ask about the inflation outlook. In March, you described the standard practice of looking through energy shocks as conditional on inflation expectations staying anchored. Since that meeting, there has been very little progress reopening key energy trade corridors. Can you help us understand how the inflation outlook has changed in the intermeeting period, beginning with the prospects for tariff pass-through resolving on the timeline that you had outlined in March, before getting to the energy shock that is now on top?
So, I would look at it this way. For a long time, we've been working on the hypothesis, really, that tariffs would lead to a one-time price increase and that would go away over time. In other words, that there would be no further change, so measured inflation wouldn't reflect that higher level going up more and more. And it's time for that to happen. We really do expect that to be happening in the next 2 quarters. So we'll be watching very carefully to see that what we've thought all along would happen. That's the kind of critical part of the forecast. We need to really see that. With energy, it's so hard to say. I mentioned, in sort of the textbook, you would look through an oil shock because they tend to be short-lived and they tend to revert, and monetary policy works with long and variable lags, so you wouldn't necessarily react right away. I think that is all the more true given that we're several years above 2% inflation and that we're already looking through the tariff shock. So I think we're going to be very cautious about that. But the question about looking through energy really is not in front of us right now. It hasn't even peaked yet. And I think we'd want to see the backside of that and progress on tariffs before we even thought about reducing rates.
So if I could follow up, the statement today preserves language that has taken on some meaning as it was socialized when the committee was actively lowering rates. Why is that easing bias still ripe, given how different the inflation outlook is now versus a meeting or 2 ago? And what more would have to happen for it to get evicted?
So that was, as you will recall, we had a discussion about that at the last meeting, and we talked about it in the press conference after the March meeting. We had the same today. We had quite a vigorous discussion about that very issue and the guidance, and is it still appropriate and that kind of thing. And I would say that the number of people on the committee who either could support that language change,
Fuck your calls, fuck your puts,
stance so that a hike is as likely as a cut. That number has
Jerome's
increased
got you by
over
the
the
balls.
intermeeting period, and it's easy to see why. I mean, it's a good question, right? You see, inflation has moved up over the interim a bit. Core inflation's 3.2 now, moving, albeit just a little bit, in the wrong direction. And we know that there will be, that there's headline inflation coming out of the Gulf, and we don't know how much that will be. We're going to need to see. So it makes all the sense in the world that people would look at that and we'd have a vigorous discussion about that. You saw the 3 people dissented over the language. I think all of those people agreed with the rate decision.
UFO files are coming out.
The majority of the committee did not want to do that, and I didn't think we needed to do it at this meeting. It really was just a question of why do we need to do that now? We have so much to learn. There's so much uncertainty about the path ahead. There doesn't need to be any rush to make that decision now, because what happens in the next 30, 60 days, even by the next meeting, could
Man,
really
I can't believe
change
this is the last
picture
press conference
around that language. So, it's a much closer thing on the committee than it was in March, and that makes all the sense in the world, it seems to me.
Claire.
So Claire Jones, Financial Times. Just going back to this issue of the easing bias, we've now got oil approaching $120 a barrel when it comes to the benchmark Brent crude. If it stays around those levels 6 weeks from now, what would be your best guess as to whether the easing bias will still be in the statement? Thank you.
I wouldn't want to guess. Well, first of all, we're going to have new leadership in all likelihood by then, and new leadership's going to have a very important role to play in that. So I won't be standing here at this podium to answer your question. So I don't know. As I mentioned, that's all I can really say is that we had a great discussion about that today. It's gotten to be a better question in the interim period. We had the discussion. A majority are still on the page of of not feeling the need to move
We're going to
to
have
that
Jerome
level.
Powell and Kevin
That's where
Warsh
I am.
fighting in the background.
I get it, though.
the next
You know,
meetings.
at a certain point, you would move, and
They're gonna
that,
be
that conceivably could
coming
come
on
as
late
soon
because
as the
they're
next meeting.
arguing.
Thank you. Just to follow on, the new
Can see it.
leadership also seem rather lukewarm on press conferences and on the dot plots. What would your advice to him be on these communication tools?
So I'm not going to give him any advice through you today here, but I think communications generally is, I think every incoming chair takes a look at communications, and it's a very healthy thing. I mean, communications it's very complex, and you can always be.
Why has everybody
be
got to
looking
tweet
at
all
new
this shit
things,
in all
and
caps? Get the
if
fuck
that
out of here
happens,
with that bullshit.
Feels like it's going to happen. That's completely.
Everybody's
appropriate
tweeting in
thing.
all caps. Get the fuck out of here, bro.
Neil.
Y'all suck.
Hi, Chair Powell, Neil Owen with Axios. Can you tell us if you've been in touch with incoming Chairman Warsh? To what extent is this a normal transition
everyone
process
tweeting all caps?
versus all the things swirling around, something unusual, and what can we expect when he takes that podium in a few weeks?
I haven't seen him since seeing him at a dinner in January where I congratulated him and had a nice chat with him. Haven't seen him. I don't know what a normal process is. The last process was with Janet Yellen, with whom I had worked for 6 years, and so it was. We were sitting down the hall from each other, so it was a very different thing. I think this is and will be a very normal, standard kind of a transition process. So that's what I expect. I have every reason to think it will be.
Quick follow-up, is the Supreme Court ruling on Governor Cook a factor in when you may leave as a governor?
I wasn't thinking of it as such, but no, not really. I mean, I'm thinking more of the other things I mentioned.
Chris.
Hi, thanks for taking our question. I wanted to ask a question about your tenure and Chris Rugaber at Associated Press. During your tenure as chair, you often spoke about how disadvantaged Americans benefited from extended periods of low unemployment. In the new framework the Fed adopted in 2020, some economists say elevated the Fed's employment mandate. Are you worried that the pandemic inflation spike that followed will make future Fed chairs more reluctant to pursue a hot jobs market, and should they be?
I don't know the answer to that. I mean, what we experienced in the teens, the mid-teens, was really low levels of unemployment for a long period of time and no reaction from inflation. And we all very much took notice of that. We also noticed that the biggest wage gains were going to people at the bottom end of the income spectrum. And we had many reports of, it felt like a fairly stable equilibrium, and a lot of benefits were flowing to people at the bottom end of the income spectrum, including companies were, setting up in people who were confined and like training them before they got out, and it was a very healthy sort of set of societal dynamics. So of course, I think anybody would love to get back to that. I don't think that anything that happened to create the global pandemic inflation was in any way related to overweighting the employment market. I mean, it was a global shock that happened essentially very similarly all over the world. That had to do with closing, reopening, stimulus, and all that. And I mean, you could look at a graph of 10 big economies on the page and not know which was the U.S. and which was Germany, France, and things like that. So I don't think that insight was in any way responsible for the high inflation that we experienced. So, I mean, I think it's always been a balance. You've got to be strong on both of our dual mandates, and we for example, now we don't feel that the labor market is at all a source of inflation, so we don't need to be worrying about that. It's been a long time since we have had to worry about that. Well, actually, during the pandemic recovery, the labor market was super overheated and tight, and that's when we had to worry about it, but not now.
And just on the other issue, do you need more assurance from the Justice Department before stepping down? Is that what you're waiting for, or what else?
I'm
is
waiting,
gonna affect your
for the investigation to be well and truly over with finality and transparency, and I'm waiting for that, and I will leave when I think it's appropriate to do so.
Michael McKee. Michael McKee from Bloomberg Television and Radio. I'd like to ask you if you could explain a little more or characterize a little more the discussion about the two-sided view and interest rates, because there were some members of the Open Market Committee who've been suggesting that we may need to raise interest rates even absent the war because
The man is a
inflation was
legend.
not
Yes,
coming
we
down
will,
fast
Mr. Jerome
enough.
Powell. In case you didn't
Is
know.
there any sense that
Bro, what?
interest rates might have to go up, or
Well,
was
did I
this
just
just
get
a setup
scammed, bro?
to
Oh
sort
my
of warn people that you're worried about the war
Oh.
impacts?
So nobody,
I just got gypped.
the three dissenters and others who could have supported that, and others who were, who were voters and non-voters who preferred it, they all supported the rate
No, I'm
decision,
kidding.
right? So people are not saying we need to hike
I'm
now.
writing
It's
some
more a
shit.
question of, don't we kind of
Yo,
feel
bro.
that we should be
fuck?
neutral? And what are markets doing? People argue that this is consistent with markets are doing. And again, it's a very fair question, but, these changes, there is, it's a form of forward guidance, and you don't want to make them in a way that will be sustained and continue to make sense and not something you need to take back, fairly quickly. So I think a group of us, including me, didn't feel like we needed to be in a hurry on that markets are not confused about our reaction function. We don't have a problem to solve on that. But the other side of the argument is a good argument, too, as I mentioned. It's a perfectly good argument to be having, good discussion to be having. So, and it came out the way it came out.
Well, you've got three dissents in favor of two-sided warning. You've got yourself staying on the board. You've got the criticism that does come from elected officials, and you've got a lot of critics who have faulted the Fed for being too slow 2021 with inflation. Are you worried about Fed credibility under all of this? Is that one reason that you want to stay on?
Not driving my thinking now. I mean, monetary policy is going to get made by, 19 people. There's a lot of stability there. I mean, if you think about it, every new Fed chair has the same situation, which is you've got 18 colleagues on the FOMC, 11 of them vote during any year, and your job is to create consensus. It's to talk to them, understand them, be inside their thinking, and be able to pull them together and get consensus and move. And that's what every Fed chair has to do. And I think Kevin Warsh is actually quite well. He has the capabilities, skills to be very good at that, I would think. So I think I'm not so worried about that process. I think that'll work itself out.
Howard.
Thank you, Chair Powell. Howard Schneider with Reuters. You mentioned that staying on as a governor, you intend to keep a low profile. I'm
Young
just wondering
Kevin.
if you could give us a little more detail on what that looks like and how you can. Touche. Walk down the steps. What that looks like, and particularly around the policy discussion, how you're able to have your intervention and not be a shadow chair and not have a kind of an outsized influence over the process.
Yeah, that's just something I would never do, the shadow chair thing. No, I don't know what the exact specifics of it will be, but I'm going back to being a governor. I respect the role of chair. I was a chair. I was a governor for 6 years, and I know what that's like. I know it, and I had a pretty front row seat particularly with Chair Yellen, to whom I was close when I worked with Chairman Bernanke for 2 years, but I was brand new at that time, so I got a sense of what it was, and I had real sympathy for how hard it is to get that group to consensus. And I always felt like I don't want to add to that unnecessarily, and that means try to support the chairs where the direction the chair wants to go in, if you can. If you can't, you can't. And I think that's the way it's always worked there, because the chair only has one vote, plus the ability to develop consensus. And if people won't be, they won't, if they're not flexible at all, then how do you ever do that? And so that's why the authority the chair has really is to develop relationships with people and work with them, and then put something forward that has consensus. And I propose to be a very constructive participant in that process, really out of respect for the office of the chair.
And in your view as a soon-to-be governor, How do you see the risks of oil prices bleeding into core inflation in coming weeks? Because that was, it seems like the commentary that was coming from particularly some of the Reserve Bank presidents, they were elevated concerns about the bleed into core. And, here we are with 3 cents now. What do you see as the prospect of a core inflation?
Those prospects are real. Remember, though, and they're real, and the real thing is we're going to have to wait and see. We're going to need to see. And the good news is we think our policy stance is in a very good place for us to wait and see. We're right kind of at the high end of neutral or perhaps mildly restrictive. The labor market shows more and more signs of stability, whereas inflation is kind of misbehaving. And so maybe a little bit of restriction or the high end of neutral is just the right place to be. So we can wait here and see how things work out before we act. And we'll see how much that, how much does come through into core. You see it already in airfares, of course, but you may see it in many other places. We just don't know yet, and it's so unknowable because how long will the strait be closed? You can develop any number of scenarios that you want, but we really won't know until we know. So fortunately, we're in a good place to wait and let things develop.
Thanks, Mr. Chairman. You started holding post-meeting press conferences for every meeting as opposed to the ones with just with SEPs. Can you talk about why you see that as a net positive?
So we always said when we were doing quarterly press conferences, we always said we can move at any meeting, but we only ever moved at the quarterly SEP meetings where we had the press conference. So if you think about it, during the pandemic, we were moving like a lot at every meeting and sometimes between meetings, and doing that with our press conference, I think, would have been quite challenging. It's become the industry norm. It's the standard. I don't know whether that has to remain that way. I don't know. I mean, it's just something people have become used to, and I do think it's quite helpful to, I try to deliver a message on behalf of the committee rather than 18 other people going out and delivering their message, and it's going to be all over the place because we do, thankfully, have widely disparate views.
Okay, thanks. The other thing I wanted to ask about was the communications review from last year. Could you describe the debate last year, what changes were considered, what you wanted, and what prevented action, any action on those changes?
So yeah, I'm not going to go into the real small specifics, but what we found very quickly was that making changes, making really large changes, for example, to the dot plot or the SEP, it didn't have, we couldn't come up with anything that had really broad support on the committee. And so we just moved on. We didn't really do as much on that as we might have. And I was never the world's biggest fan of the dot plot, but you can't beat something with nothing. And we've looked at a bunch of things, and it's something. Like I said, I think every new chair is going to look at our suite of communications, and think about what would be changes. We are the only major central bank that doesn't publish a forecast, and that's because we have a 19-person committee, and you try to do that at the board.
About to power hour right now in 1 minute.
It's hard if you do it at the staff.
5 seconds.
It's been.
I haven't even pulled up
I
the
think our
charts.
communications are
I'm just
fine,
listening.
but looking at doing it in a different and better way is the most natural thing in the
Getting a
world.
pump. Looks good. We got a sweep. Go long.
Thank you. Colby Smith
Mine's
with the New York
red by
Times.
0.14%.
If I could
Let's see it
follow
go
up on
green.
Mike's question about hikes, are we right to assume that the hawkish outcome for the Fed is still one in which the committee just extends the pause in rate cuts? And to what extent is there a growing sense within the committee that monetary policy really isn't just restrictive
Contracts are
at all
expensive,
right now? The economy is holding up relatively well despite this major energy shock. The unemployment rate has ticked lower. Inflation was moving sideways even before the war and is now moving higher. So where is the committee at on that debate?
Where we're at is we think our policy rate is in a good place. If we need to hike, we will certainly signal that, and we will certainly do it. And if we need to cut, then, or if it's appropriate to cut, then we'll signal the opposite. I think because we feel like we're in a good place to move in either direction. Nobody's calling for a hike right now, so it really is going to depend on how things evolve, and that's really where it is. As I mentioned, much closer question this cycle on changing the guidance, but ultimately we didn't.
And as it relates to the war, at what point do you think the risk to growth will be larger than the risk to inflation as this conflict drags on?
You just have to find that out empirically. Given our the fact that we're a big exporter of energy, and that our economy is far less energy intensive, oil intensive than it was during the 70s, the effects on the United States are really substantially less than those of Western Europe or Asia, who are feeling much greater effects from these things. The effects we're feeling in the current situation currently, and in sort of what's priced in, which is a relatively quick outcome. If this goes on for much longer and prices go much higher, then we'll feel that much more. And of course, I'm talking about aggregate inflation numbers. We're very well aware that people are experiencing higher gas prices all over the country now, and that hurts. And those hikes may continue to happen. And other things are going to start to reflect airline fares I mentioned, and other products and services that are dependent upon petroleum and derivatives of petroleum. People are going to start to feel that.
Edward.
Thank you, Chair Powell. Edward Lawrence with Fox Business. So I guess I'll just ask you directly on this. The markets don't see a rate cut at all this year, is what they're predicting. Do you think that we are at the neutral rate? Why or why not?
The neutral rate is we cannot know it with certainty. I think pretty close to the neutral rate. Yeah, I always had it between 3% and 4%. We're a little north of 3.5%. So that's well in the range of what I would consider a reasonable, but at the higher end of the range of what I would consider reasonable neutral rate. I think the labor market is still probably cooling off just a little bit, and I don't think there's much of a case for any case really for policy looking meaningfully restrictive, maybe mildly restrictive or neutral, I would say.
And I want to follow up on some of the other questions about your future a little bit. The first time we've seen 4 dissents now since October of 1992, are you handing off a divided Fed?
The thing to remember is we have always had vigorous debates, and they're excellent debates. I have to say they've been really good, and we're in an unusually difficult situation. So we've really had 4 supply shocks. You can say more than 4, but at a minimum, we had the pandemic, we had the invasion of Ukraine, we had tariffs, and now we have Iran and the oil, the oil spike. So every supply shock has the capability of driving inflation up and unemployment up. And what do? The central bank has a really hard time knowing what to do. So the right thing to do is to try to balance the achievement of those 2 goals, and that's what our framework calls for us to do. But these are really tough, difficult judgments. You've got to have a forecast for each variable. You've got to think how long it's going to take to get back to target. You got to think how restrictive or not is policy. So it's only natural that you have a range of views on the committee. People are going to see it different ways. They're going to have different risk tolerances and that kind of thing. I mean, if everybody agreed, that would be surprising. And I think it's partly a function of the extraordinarily challenging set of supply shocks that we've been dealing with now for 5-6 years.
Thank you so much, Chair Powell. Selena Wayne with ABC News. Are you confident that Kevin Warsh will stand up to political pressure from President Trump?
So he testified very strongly to that effect in his hearing, and I'll take him at his word.
And when it comes to gas, right now it's over $4 a gallon. Inflation just hit a 2-year high. Should Americans expect to be paying higher gas prices for the rest of this year? And in your view, does that take a rate cut off of the table? And secondly, by staying on as Fed governor, what message do you think you're sending to the president?
I don't know what gas prices are going to do for the rest of the year. And it will depend on how long the strait remains closed and how quickly it can be reopened and that kind of thing. But remember, when gas prices go up, that's disposable income coming out of people's pockets, so they're going to spend less on other things. So there will be a hit to GDP. So it's a, it's a question whether spending, goes down to offset the inflationary effects. So it's not, the answer isn't obvious ex ante whether you should move your rate over because of that. We'll have to see how it evolves.
And the message it sends to President Trump by staying on?
I'll stand on what I said earlier.
Victoria.
Hi, Victoria Guido with Politico. During your tenure, Fed independence has come under pressure in a lot of different ways. And I was just wondering, practically speaking, where do you see Fed independence as coming from? Is it the law? Is it political support from Congress? Is it the actions of the Fed? What sustains Fed independence?
Well, it's to a significant extent, it is the law. And, we've had to go to court to successfully so far to defend it. But the law does create a setting in which the Fed can and is directed to make monetary policy without consideration of political factors. And so part of it is the law. But it goes beyond that, though. There's a set of customs. There's a boundary line between the Fed and the administration, between the Fed and the Treasury Department. And we need to continue to respect those boundaries about what the Fed is responsible for and what the Treasury is responsible for and what the rest of the administration is responsible for. So some of it is legal. In fact, it's all legal at the end of the day, but it's more than just monetary policy. We don't want to use our tools we haven't wanted to use our tools to achieve goals that are really clearly outside our mandate. Every administration looks at our tools and thinks that would be good to repurpose those to serve other purposes, but that's dragging us into politics and into fiscal policy. So we've resisted that.
Well, and maybe another way of asking it, too, is do you think that Fed independence is as strong now as when you became chair? And if so, why?
Look, I think it's at risk. I mean, I think these legal assaults, if you will, as I mentioned, the institution is being battered over these things. We're having to resort to, the courts to enforce our legal, it's not so much independence. It's really the ability to make monetary policy without political considerations. That's what we're talking about, and we've had to do that, and we've been successful so far. But that's not over. None of that is concluded yet, and it's really important. It's not about people who work at the Fed or the institution. It's about the benefits of a central bank that makes decisions based on analysis and our best thinking, rather than trying to help or hurt politicians. It's that there's a bright line between central banks who do one and do the other, and successful countries have uniformly, successful advanced economy countries have a really strong set of protections around their central bank just for that reason. So that's what it's all about. I think I am confident, as I said in my remarks, that the Fed will continue to make its decision based on analysis, rigorous analysis, and not on political considerations. But we've had to fight for it, and I'd like to think that we can get out of that era and go back to respecting, what the law says and what custom has been, which is to, let the Fed do our thing. It's an institution full of human beings who work super hard to get things right for the benefit of the public. We're all human. Don't expect perfection, but do expect us to make, decisions without political considerations and the very best analysis we can bring.
Katerina Saraiva, Bloomberg News. How would you characterize what you've heard from your colleagues on your decision to stay? Do you have their support? And then have you heard concern from your colleagues about continued legal attacks from the executive branch?
Why am I not
Is this
invested in
something
coconut
that
water? What the
others
heck?
have, talked to you
I've been
about?
drinking it so much lately.
I think that
For like a couple of years now.
I don't want to report on what my colleagues think. They can speak for themselves. But there are widespread concerns that these things may continue. That's all I'll say. And and that would be a problem. And
I stopped driving. I don't worry about gas.
And then I just also wanted to ask about
The electric
Governor
vehicle doesn't
Waller's
concern
speech on the
itself with
reserve
gas
banks.
prices.
What, do you have any thoughts on
I got a
centralizing some
scooter.
of those
I don't have any
functions in
car.
the way he described?
It's electric.
And then are you concerned that something like that could potentially be a slippery slope to, to consolidate reserve bank functions even more in such a way where the central bank ultimately loses some of that important regional information?
So we try to be good stewards of the public's money and efficient, and Chris in particular, Chris Waller, is particularly passionate about that. Of course, so are the reserves, so are the presidents, and it's a question of how do you accomplish it. We of course, and Chris said this in his speech, we want 12 strong independent central banks with their own staffs and their own monetary policy views and all that. But there are things that are done in all 12 which could well be done
Trying to
in
go
one
higher
much
here in
more efficiently
7-Eleven.
and with cost savings. And so there's a back and forth going on
Not
that,
green
but
yet.
everybody's on the same page. The other thing he touched on was the idea of removing reserve bank presidents from office over different views on monetary policy. And I would just agree with him so strongly that would be the beginning of the end of the Fed's ability to make monetary policy independently. If every administration could come in and do that, you're just another cabinet agency at that point. So that's not something that I would support. Chris said the same thing.
Christine. Thanks, Chair Powell. Christine Romans, NBC News. I want to ask about legacy. When the history books are written, how do you think your stewardship at the Fed will be remembered for the past 8 years?
I'm going to just say that that's for someone else to say. I'll give you a mulligan on that.
All right, I'm going to ask you about misbehaving inflation then. You talked about those 4 big shocks, supply shocks over the past 5 years, and inflation still misbehaving. What's your message to American families who feel like inflation has not been under control for them really since the COVID reopening?
We're committed to bring inflation back down to 2% and sustainably. That's our goal, and we'll stick at it until that happens. We keep getting these events keep happening, which keep driving up costs, and the best thing we can
Contracts
do
are too
is to
expensive for my
use our
liking
tools
now.
to guide
I'll say
inflation
that.
back down to 2%. I think trying to get there really quickly
I'm not going
could
5
be very
strikes out
costly
right now.
in
4
terms
strikes out. No.
of job loss and things like that.
I'm
But
good.
We try to get there over time in a way that does the least damage possible.
I got some
and,
things to say
our
about
commitment to
Jerome
that
after this.
is never ending and unshakable.
How would you describe the economy outside of the misbehaving inflation? I mean, it's still awfully resilient given all of the blows.
I don't know that you can be awfully resilient. So it's actually quite resilient, I would say, because it's a positive thing. If I can have that amendment, yeah, growth is really solid across our economy. Some of that is that consumer spending is hanging in pretty well. The most recent data are good. And some of it is just the apparently insatiable demand for data centers all over the United States. So a lot of business investment going into building data centers, and every reason to think that continues. So you've got an economy that's growing at 2% or better. PDFP, which is private domestic final purchases, which is really a better signal of a momentum in the economy, is actually higher than that. So that's a positive thing. If you look at the unemployment rate, it's 4.3%. So that's a low rate. That's pretty close to mainstream estimates of the natural rate. We've been there for a long time. So it doesn't feel like a good labor market to some who don't have jobs, because quits are really low, hires are really low, and there's effectively no new net job creation. So that's in a sense, the labor market is in balance. But it's an unusual and uncomfortable kind of a balance where people who don't have jobs will have a hard time breaking in unless somebody quits their job. So that's pretty good. Inflation is the thing we need to work on, and it's partly tariffs, which we think that inflation should subside over the course of this year, because it's kind of a one-time increase. It shouldn't be repeated, and that should start happening pretty soon. The energy inflation that we're getting should go through fairly quickly. And we'll just have to see how that works out. In the meantime, we think our policy stance is in a good place for us to hold and wait developments.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. At the risk of beating the dead horse here, clearly 3 members objected to keeping that easing bias in the statement. And you said that the majority still didn't need to move to new language at this point. So does the majority of the committee still have a bias towards cuts at this point, or has the bias on the committee shifted away from cuts towards holding or hikes if that was needed?
So I think that, the center is moving toward a more neutral place, and that's sort of what markets are saying too. I just think, there's a lot of signaling going on when you change guidance like that. And so we just, I guess a majority of us didn't feel like we needed to send a signal on that right now. But maybe it'll come to that. And the reason is because, we're kind of waiting to see what happens with events in the Middle East and what are the implications of those events for the U.S. economy. So there's a group who feels like we don't need to be in a hurry to do that. We get it, and of course we will move to a hiking bias if we want to hike, and we'll move to a neutral bias before that. But there was a difference over whether to do it at this meeting, at a meeting at which all but one of us agreed that the rate decision was correct, which was not to move.
And you just said moments ago that you believe Fed independence is at risk. Is it safe to say that you want to stay on as a governor to
S&P
serve as a
divergence
check
on
and
big
balance on
technology,
that?
daily chart. Big technology.
I want to stay
going
until
higher.
I will stay until I feel it's appropriate for me to leave. And yes, that is
Positive
really
bullish
what is driving
divergence on
this.
QQQ
I'm
over
not.
SPY.
I'm not looking
just
to
an
be,
observation.
a high-profile dissident or anything like that. I'm more looking at the other aspects of this and wanting to see that things have calmed down and we're returning to a traditional model of working with the people that you have and bringing them to consensus and respecting that consensus. That's what I'm hoping to see.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. You've made many tough decisions in your time at the Fed, and as your time as chair comes to a close, and you think about your tenure and perhaps your legacy, are there any decisions that stand out as ones that you're particularly proud of? And are there any that, with the benefit of hindsight, you would take a mulligan on?
Yeah, it's hard. I wouldn't want to single out
Why still down
individual things at this
0.06%?
point. I'll just say, we all of us together have consistently tried to do what we think is best for the American people based on our tools and our objectives that Congress has given us. It's been very challenging because we've been in a situation of supply shocks really for 6 years, and that's just a very different situation than for a very long time. What the Fed and other central banks were doing all the time was demand management. And, and there was always the inflation mandate, but inflation was low for 25 years. So this is a very different world and a much more challenging one where you have to balance the two objectives. And by the way, central banks that have an inflation mandate have to do exactly the same thing because they're balancing economic activity. So that's been challenging. And we've tried to do our very best through these really challenging times. And I'm really proud of the work that I've done, that my colleagues and I have done during these years.
Now, to follow up on some of the discussion around Fed independence, can you explain to the public why this notion of Fed independence, which might sound kind of wonky to some, is so critical? I mean, what are the consequences if either the Supreme Court rules against Lisa Cook or the Fed in the future decides to make decisions more around the political calendar instead of the economic data?
So every major advanced economy in the world has made the same decision the United States has made, and that is that they want to take the making of monetary policy, the setting of interest rates to support the economy, to achieve maximum employment and price stability. They want to take that out of the direct control of elected politicians. And the reason is elected politicians are always running for election, and they'll always want low rates, and that will lead to inflation over time. So after literally centuries of experience with that, the whole world moved to the different model, and it's worked great. I mean, this is the era in which inflation was under control for 40 years. Then we had the pandemic, inflation everywhere in the world, and now we have inflation that had gone pretty much all the way back to target, really close to all the way back to target, and now is being buffeted by the energy shock, and the U.S. buffeted by the tariff shock as well. So, but what I would say to the general public is that's the backstory, is that don't think about an institution being independent. Think about it this way, that you want people to make monetary policy and set interest rates to benefit the general public and to try to achieve economic goals, which are maximum employment and price stability, and focus only on that and ignore political considerations, completely ignore them. This isn't bipartisan, this is nonpartisan. So we want to just work directly for the American people doing these things. We don't think, oh, I want to do this because the president says it's a good idea, or because there's an election coming up and I want to speed up or slow down the economy.
Economics is nonpartisan.
Think about that. If that's what
Economics
we were
is
doing,
better and bigger,
we'd have no credibility.
more
Markets would lose
beneficial than
faith in
politics.
us, and our ability to control
whole take.
inflation and have any respect would be gone. And let me say, whatever people say, the markets believe in that we will produce 2% inflation. If you look at longer run expectations, markets believe that there's no sense in which our credibility in the markets has weakened. It's just not the case. It's people do get it, that this is our commitment and that we will achieve it, and it's priced in. If you disagree with that, then you can go ahead and bet against the markets, but the markets are pricing in Fed credibility.
Okay, we'll go to Richard for the last question.
Thank you, Chair
Maximum
Powell.
employment
Richard
and
Escobedo with
2%
CBS News.
inflation.
We talked a lot about gasoline
Long-term
prices
goals.
and
That's
even
it.
you mentioned airline
It's
ticket
very simple.
prices, both of which are up dramatically because of the war in Iran. And so I wonder, are you seeing that weigh down consumer spending in other parts of the economy? And if so, how worried are you that that will be a drag on growth?
You don't see it in spending yet. You really don't. I mean, as one of your colleagues said, the economy has been resilient. It really has. Not just this time, but it's been remarkably resilient for some years now. The U.S. economy has just powered through shock after shock, and consumers are still spending, and that's what the banks will tell you, credit card companies will tell you, the retail sales numbers that we got most recently. People are still spending, and how long can that go on in a world where if gas prices were to go up a bunch more, that's taking otherwise spendable money out of people's pockets. But right now, we don't actually see much slowdown yet, and certainly none from this. But you think logically you will, because people have a certain amount of money to spend. If they're spending 25% more on gas or something like that, then that's going to come out of other spending. But we don't see it yet.
One last thing. You mentioned those economies in Southeast Asia that are particularly dependent on petroleum. They make a lot of the stuff that American consumers buy. So was there any discussion today about whether or not those costs getting passed along to consumers is a real concern, and whether or not that might push up inflation?
So all of those things are in the models that we use to calculate inflation. So they're just parts. You can ask about anything like that, and they have a place. The staff has a place where they're looking at that and pricing in what will happen with higher prices and that kind of thing. So it's there. The effects are not that big yet. We're a huge economy. The import sector is only 10% of the economy, so we're not like a European country where 50% of the external of GDP is in the external sector. We're also, as I mentioned, we're an oil exporter, so we're not feeling the same kind of pain, and we're not likely to feel the same kind of pain that economies in Western Europe and certainly in Asia are feeling. Anyway, thank you very much, everyone. I won't see you next time.
Okay, that's the end of the presser here. Wow, what a What an outro here. Man, my computer's tweaking all it. And my computer's being weird. All right. So that's it. Let's look at the markets here. The charts aren't really doing too much here. All right. All right, so a little bit of a history on Jerome Powell, a little bit of a background, and to commemorate this final FOMC meeting with Jerome Powell as the chair. May 15th is the term end date, and seems like Powell isn't too opposed to the Kevin Warsh nomination and the new Fed chair incoming. He's going to remain as a Fed governor. He doesn't want to be a shadow federal chair, so he's looking to really continue the work that he's doing, except without notoriety. Well, I forget the way he said it, but he's going to be on the sidelines. So Jerome Powell and the Federal Reserve, the man before the chair. Jerome Powell was born on February 4th, 1953 in Washington, D.C. He went to Princeton University for politics in 1975, Georgetown University Law Center in 1979, where he served as an editor-in-chief of the Georgetown Law Journal. After Princeton, he had, by his own account, no plan and no job. He spent 6 months putting labels on shelves in a warehouse before law school, and he later called it exactly what he needed. As a corporate lawyer in New York, an investment banker at Dillon and Reed Co., 1984 to 1990, and under Secretary for Domestic Finance, U.S. Secretary under President George H.W. Bush, 1990 to 1993. Responsible for debt management and financial institutions and treasury markets. He was a partner at the Carlyle Group from 1997 to 2005, founded Severn Capital Partners, a boutique private equity firm, in 2005, visiting scholar at the Bipartisan Policy Center in 2010 and 12. Every Fed chair since Alan Greenspan in 1987 has held a doctorate in economics. Powell does not. He's the only practicing lawyer and private equity executive to lead the Federal Reserve in the modern era. Appointment to the Federal Reserve Board of Governors, appointed by President Barack Obama, May 25th, 2012, as a Federal Reserve Board as a governor, which he's now coming back into. Filing an unexpired term, the nomination was the first since 1988 that president nominated a member of the opposition party to the board. Since Obama was a Democrat, Jerome Powell is more aligned with the center-right, mid-right. He's more of a Republican capitalist, obviously. He's head of the chair, Federal Reserve. Anyways, reappointed and sworn in June 16, 2014, and through the mid-2010s, Powell built a reputation as a consensus builder and pragmatic centrist, supporting post-2008 recovery policies while generally favoring gradual normalization. And his elevation to the chair was nominated by President Donald Trump, November 2nd, 2017, during the first term, sworn in as the 16th chair of the Federal Reserve, February 5th, 2018, succeeding Janet Yellen. At the time of his appointment, Powell was the wealthiest Fed chair since the 1940s, with a reported net worth between $19.7 million and $55 million. He inherited an economy in its, well, actually 104th-ish consecutive month of expansion, the longest in recorded U.S. history, with unemployment at 50-year lows and inflation running just below 2%. So in 2018 to 19, the normalization of the Fed, Powell pivot. Powell continued the rate normalization path that was begun under Yellen, raising rates in 2018, and as the economy had expanded. And by December 2018, markets had sold off sharply, with the S&P 500 down approximately 20% peak to trough. Early 2019, Powell signaled a pause in the hiking cycle, a shift that markets and commentators immediately labeled the Powell pivot, demonstrating his willingness to reverse course under financial stress. The Fed cut rates 3 times in 2019 in response to trade war uncertainty and slowing global growth. And throughout this period, Trump publicly and repeatedly attacked Powell for raising rates, arguing moves would slow economic growth. And in July 2018, Trump had also stated in a CNBC interview that he was not thrilled with the Fed's rate increases. He's never been an advocate for increasing rate cuts ever, or increasing the interest rates. In January 2019, Powell publicly stated that he would not resign if asked to do so by the president, which he was. February 2019, Bloomberg reported that the Office of the White House Counsel examined whether Trump could legally remove Powell. Powell's consistent response is that, "I think the law is clear and I have a 4-year term and I intend to serve it." Okay, and then moving into the COVID-19 crisis response, March 2020, which is one of the next big crises, and probably the biggest one that we've dealt with under these 2 terms. U.S. economy entered the sharpest contraction on record. Real GDP per capita fell at an annualized rate of negative 24.7% by Q2 of 2020, compared to negative 3.7% annual rate during the Great Recession, 2009 to 2016-ish. Employment reached 14.7% April 2020. The Federal Reserve's response was the most forceful in its history, and on March 3rd and March 15th, 2020, the Fed cut the federal funds rate by a combined 1.5 percentage points to a target range of 0% to 0.25%, which doesn't happen often when you get the 0% interest rates, which is also creates other problems down the line, but I'm not getting into that. 9 emergency lending facilities were established in under 3 weeks, including the corporate credit facilities, the Main Street Lending Program, the Municipal Liquidity Facility, and the Paycheck Protection Program Liquidity Facility. And finally, the Primary Dealer Credit Facility. The Fed's balance sheet surpassed its prior all-time highs of $4.5 trillion by March 2020, and it exceeded $7 trillion by May. Powell at the Brookings Institution in April 2020, 6 years ago to the day. "We were deploying these lending powers to an unprecedented extent and will continue to use these powers forcefully, proactively, and aggressively until we are confident that we are solidly on the road to recovery." In Powell in May 2020 speech, he also drew a critical institutional boundary. The Fed has lending powers, not spending powers. As well as he said, "This downturn is different from those that came before it. The virus is the cause, not the usual suspects." The combined peak in emergency facility balances reached just above $200 billion in July 2020. Markets stabilized rapidly. The crisis era facilities widely credited with preventing the liquidity crisis from becoming a solvency catastrophe. And then the flexible average inflation targeting, FATE, August of 2020. At the Jackson Hole Symposium in August 2020, Powell announced the adoption of the flexible average inflation targeting, or FAIT. The new framework allowed inflation to run moderately above 2% for some time following the periods in which it had run below that level, and explicitly tied liftoff to from zero rates to achieving broad-based maximum employment. This was a structural shift in the Fed thinking, and acknowledgement that the prior decade's persistent undershooting of the inflation target had left workers, particularly those at the lower end of the income spectrum, with less than the labor market could deliver under a more accommodative stance. The transitory inflation judgment and its consequences in 2021 as the economy reopened and pandemic-era fiscal stimulus flowed through the system. Inflation began rising sharply. Throughout much of 2021, Powell and the Fed characterized the inflation as transitory, driven by supply chain bottlenecks, good sector disruptions, and base effects that were expected to resolve without requiring monetary policy response. And in a 60 Minutes interview in February 24, Powell addressed this directly. He said, "In hindsight, it would have been better to have tightened policy earlier. We saw that we thought was inflation mostly limited to the goods sector and the supply chain story. We thought the economy was so dynamic that it would fix itself fairly quickly. That was a very widely held view of economists around the world, and the data were kind of friendly to that assessment right up to the point when they weren't." And by the fourth quarter of 21, it was clear that the inflation was not transitory. At the November 21 FOMC meeting, the Fed announced a phase-out of asset purchases. At the December meeting, the taper pace was doubled, and over the period of the pandemic-era purchases, the Fed securities holdings had increased by $4.6 trillion. In October 2025, at an NABE speech, Powell offered a more precise formulation on the same admission. He said, "With the clarity of hindsight, we could have, and perhaps should have, stopped asset purchases sooner. Our real-time decisions were intended to serve as insurance against downside risks." And then now, 22 to 23, the tightening cycle. The Fed began its rate hike cycle on March 17, 22, raising rates by 25 basis points. The US CPI peaked at 9.1% year-over-year in July 22, the highest reading since 1981. The Fed proceeded to hike rates 11 times through July 23, and raising the benchmark rate by a cumulative 5.25 percentage points from near zero to 5.2 to 5.5%. This is the most aggressive tightening cycle since Paul Volcker in the early 1980s. In a 2022 press conference in July, Powell said, "My colleagues and I are acutely aware of that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% goal." The consequence of the speed and magnitude of the tightening were significant. In March 2023, the Silicon Valley Bank, Signature Bank, and the First Republic all failed in rapid succession, each having accumulated large portfolios of long-duration Treasury securities that had declined sharply in market value as rates rose. The three failures represented the largest concentration of bank collapses in a single period since 2008. The Fed's emergency response, expanding its balance sheet through lending facilities to contain contagion, was widely credited with preventing broader systemic stress. Trump would never acknowledge that. Anyway, Powell ran the most aggressive tightening cycle in 4 decades without triggering a deep recession. Whether that constitutes a soft landing or a delayed reckoning remains one of the contested empirical questions of his tenure. So, in the final months from 2024 to 26, by mid-24, inflation had declined significantly toward the 2% price target, which turned out not to be so transitory. It took 3 years. Though consumer confidence remained subdued, Powell noted in a public statement, "It will be some time before people regain their confidence." The Fed began a cautious easing cycle, cutting rates in September 24 for the first time since the pandemic emergency and signaling a data-dependent path, which they followed until today. Powell's final FOMC meeting today, April 29th. He closed his tenure with the federal funds rate at 3.5 to 3.75% and headline inflation running at approximately 3.3%. I'll add in that true inflation is, I'll have to check the true inflation. It's around 1 point some percent though. So I like the true inflation statistics. It's a little bit less convoluted. Anyway, the Fed's balance sheet stands at $6.7 trillion now. So across Jerome Powell's tenure, Powell faced sustained political pressure from both directions. Trump has criticized Powell publicly for raising rates during his first term and again during his second presidential term, and for not cutting rates fast enough. In January 26, Trump announced the nomination of Kevin Warsh as Powell's successor, and the DOJ opened an investigation into Powell which was later handed to the Fed's Inspector General without charges. And in response, Fed former chairs Greenspan, Bernanke, Yellen, along with the former Treasury secretaries and senior economists, issued a joint statement calling the investigation an unprecedented attempt to use prosecutorial attacks to undermine the Federal Reserve's independence, which is the whole point of the Federal Reserve, to be independent from the government and to be independent from political objectives and focusing on economic ones. And that's what really matters, actually, for most people. Most people don't care about anything but economic objectives. Janet Yellen stated publicly that Trump's demands for the Fed to cut rates to lower the national debt's interest burden is the road to a banana republic. We don't want that. There's examples of that in other places, which we're not getting into. Powell's own response to the sustained pressure over 8 years was consistent. He did not cut rates under political pressure. He did not resign when asked, and he did not yield on institutional independence. His term as chair concludes May 15th, 2026. His separate term as board governor runs to January 28th. And as of the date of this, he has not publicly confirmed whether he would remain. But he will remain until 28. He did say today he plans to stay on as he actually said, I will continue to serve as governor for a period of time to be determined, which I would assume is going to be until that January 2028. Okay. And so Jerome Powell's 8 years encompassed the largest balance sheet in the institution's history, with the worst inflation in 4 decades, the fastest tightening cycle in a generation, and 3 bank failures inside 10 days. He admitted the decisions that were wrong. He defended the ones that he believed were right, and through sustained political pressure from 2 presidents of opposing parties, he never compromised the independence of the institution he was entrusted to lead. Jerome Powell's and the Federal Reserve's effectiveness depends on one principle above all, that its decisions are made out of the basis of data and mandate, not political instruction. And Jerome Powell held the line every time. And in April 2020, Jerome Powell said, "We are deploying these lending powers to an unprecedented extent and will continue to use these powers forcefully, proactively, and aggressively till we are confident that we are solidly on the road to recovery." And in the next month, he said, the Fed has lending powers, not spending powers. In July 22, Jerome Powell said, "We are strongly committed to returning inflation to our 2% goal. We will keep at it until the job is done." In the same month, he said, "My colleagues and I are actively aware of high inflation and pose a significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation." Okay. And then today, the FOMC stated that they have decided to leave our policy rate unchanged. We see the current state of the monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. And also, Jerome Powell mentioned today that the U.S. economy is the envy of the world, which is pretty much the culmination of all the work that they've done within the Federal Reserve over the past 8, 9, 10 years. And so, history will account for the rest and what comes next. So thank you, Jerome Powell, for all the work you've done, for actually sticking to the plan, holding down for the ones who actually care about economic certainty and beneficiality for the whole of our people, Americans, within the country. And with the independence of the Fed to remain steadfast in decision making, even under pressure. I'm sure it's not an easy thing to do. And Jerome Powell might have been the best guy for the job. Now we're going to have Kevin Warsh. We have a warm welcome for Kevin Warsh coming in. There's really a lot to get into there. I'll do that another time. And I'm still doing some research on Kevin Warsh. But I think Jerome Powell seems to be somewhat accepting, maybe not approving fully, but accepting of it. And I think that's a good thing for us to lead off on. So that's it. The final Federal Open Market Committee meeting, press conference with Jerome Powell as the chair of the Federal Reserve, April 29th, 2026. He's not going anywhere. We just won't hear directly from him as much. Not during the meetings. We're going to be hearing some new information, some new opinions, some new takes, but he will still have a say in what the Federal Reserve is doing. And given that his tenure has been quite successful, given all the crises and all the different pressures that has been led upon him, now I think there's room for a massive growth, massive expansion in our economy that we haven't seen since the likes of before COVID took a bit of a crap on that progress that we were making. And the credit, the private equity investments into our economy right now with data centers and with technology like artificial intelligence and automations and robotics and energy development and all these new programs that are supposed to help keep the economy stable while we're doing all this spending on all these new technologies, just like back in the late 1800s with railroads. We spent tons of money on developing railroads and developing the infrastructure, which ended up failing. But later on was a blessing in disguise, because that infrastructure that was created during the time of expansion and during the time of excessive spending and speculative excess is that those railroads existed physically. Those data centers physically exist. Even if the companies fail, those places exist, those materials exist. And we're going to be able to use that no matter what, even if OpenAI goes away. They're in a lawsuit right now with OpenAI versus Elon. And, I support Elon because obviously the story's clear. If anybody knows the story, it's clear that Elon Musk funded OpenAI back in 2014-15. He started it, was a co-founder with Sam Altman. Sam Altman looked up to Elon for the whole time. Sam Altman was a big part of Y Combinator, and he was the president there at the time, or before then, something like that. But yeah, so basically all the things that's happening now, regardless of whether it plays out the way that people expect it to or want it to, the market and the economy are going to be steadfast in regardless. And even with a new Federal Reserve chairman, the market is going to continue to hold it down. Look at that, the final 10 minutes of the day, and these contracts are too expensive. I don't really have a trade, so like literally we have 10 minutes in the day, and for example, the at the money calls are $200, $150. If I wanted to spend $30, my idea is to spend $30 on a contract, risking $20. I can do that 5 times with a $100 balance. I can do that during power hour, and I can do it based on all the different confluences and type of strategy that I'm using, which is just basically momentum and directional candle by candle bias scalping on SPY. But I don't think there's a trade today because there's no $30 contract that's reasonable. $30 contract would have to be a 715 call, which is $27, and it's just way too out the money. So probably no trades, but at least we got to go over that Jerome Powell history, a little bit of a backstory around why Jerome Powell and where he came from, some of the accomplishments that he's done, and some of the best parts of the Federal Reserve that remain independent from everything else in political affiliations, which is a great thing to remain that way. Now, we want to make sure, and we know that Kevin Warsh has some type of in with Trump, and Trump seems to like Kevin Warsh, and Trump seems to think that Kevin Warsh is going to listen to what Trump says. So Trump wants the rates to be cut still to this day. He still doesn't agree with Jerome Powell holding and allowing the economy to unfold itself and to work itself out in a lot of ways, rather than forcing things to happen, which in the past have caused major recessions and depressions. We've had recessions and depressions every other year through our history. If you really break it down, we've had economic downturns, not just market corrections, but actual economic recessions and depressions over time throughout history in the United States, hundreds of times. Like, it's not a joke. You can look it up yourself. You can get a full list. Go listen to Mr. Beat YouTube channel, Mr. Beat. He makes a bunch of videos on economics and history. He just labeled like 30 different recessions over like 50 years during one of his videos. So, I mean, that's just a small example. The economy is resilient, and that's the beautiful thing. The market, the economy, United States is the most really resilient economy in the world. That's why Jerome Powell said the U.S. economy is the envy of the world. He said that today. I think that's a great quote. So, and that's a great word to go out on. So no trade. Yeah, I'm not entering a trade here. I mean, it's just like, what are we going to do? There is no trade for me today. Tomorrow I'll hop on. Definitely find a trade tomorrow likely, but my account is at $103.61. My little bit of an idea, it's just kind of like, I could take a $30 contract 5 times with a $20 risk. Obviously, that equals 100. That would be, that would count up to $100 of risk over 5 trades. And the likelihood of me losing 5 trades in a row is a bit unlikely, and the outsized returns of those type of contracts during that time should give me a way to get through this level of this account from $100 to maybe a couple $100s or so. So that's kind of what I'm looking at. I'm just looking for big momentum and direction, which we're continuing to hold bullish, looking to capture that with the AI trade technology. But I'm focused on SPY, so I'm really just, I don't know if I'm limiting myself too much, but I just don't want to move around too many charts until I get my account into the 4 figures. Once my account gets into 4 figures, I'll consider looking into other charts and doing a little bit more analysis on different stocks and not just indices for different higher quality trades, even longer trades. Maybe not. I mean, I really am focused on day trades, so I'm not really focused on swing trades. But swing trades will be possible when you have the capital to do so. Right now, I don't have capital to even consider any swing trade, even in one day, and even a 1 day, it's just not worth it to me. But I will be looking for a trade tomorrow. Not exactly sure what time, probably the final 2 hours of the day again, looking for that power hour momentum, but we'll see how the market opens tomorrow. I might try to get on early, but I have a big essay that I'm working on. I got to finish today. And tomorrow. So I'm going to have to get off here soon. 5 minutes till the close. I just really wanted to document this Jerome Powell final meeting and talk a little bit about some of the research I've done and some of the history behind the Fed and Jerome Powell's tenure in over the past 8-10 years. Because most people just don't have any idea. All right, so let's see. It's a real good bullish trend we got going on here, so. See these all-time highs on SPY, we just hit them. We got that little bit of a divergence on the NASDAQ over the SPY here. But this is not too bad. I mean, this is quite insane, honestly, this gap here and this whole run. This whole run was crazy from April. But it's the same thing as what happened a year ago, if you really look. So you can look, same thing happened. What was the bottom here? April 25, you see that? What was the bottom here? It says March. But March, April, rounded out, new all-time high. This candle that gapped up and closed at the high, I predicted would happen here, and look, it happened exactly. I said it on the stream over and over, repeated it. Obviously I didn't take a good trade on it, but my account would be more than $100 right now if I did. But just remember that this candle isn't always definitive, because if you go back to COVID or 22, you've seen this happen here, it failed, happened here, it failed. This is a bear market. This happened for a full year. This was a lot of this was due to the inflation and had to do with the economic contractions. But then we got this super bullishness with more AI trade coming in. And now we're just totally elevated. We're coming back into it like it's almost like the 90s. Look at the 90s right here. We had this rally. This is an insane rally. I mean, .com, housing bubble, COVID right here, very short-lived. 2022 bear market, very short-lived, and just the rally continues. But look at this 90s rally, where from January 95 till April of 2000, we had an absolutely insane rally. I mean, what is it doesn't measure it there. 200% rally. And we've done 780 since here, but actually since COVID. There's the market close since COVID, since this COVID candle. I think it's around that 200. You see that? 191 right there. Since that COVID, 191. This is about 230 some. It's not super, it's just a random idea, but that would be around 800, call it 780, almost 800 on SPY. But what we have here is much bigger than what we had in the .com in 2008 during COVID. People were worried about things completely unrelated to what the economy was telling us about artificial intelligence and productivity and the spending, the massive private markets, which could cause problems, but as of now, we're building and we're developing even further. Nothing to be worried about. Bitcoin's at a great spot. Really think Bitcoin is gonna do what people think it's gonna do. People think it's gonna go to 1 million. People think Bitcoin's gonna go to 300K by 28. I'm thinking that's likely. Just imagine if inflation gets back down under 2% in the next 2 years. The interest rates come down a little bit more. Next thing you know, Bitcoin's going to be 190K, 200K. And people are going to be buying it so hard, it's going to go up even higher. Then there you go, we're already there. 28, it's easy. That's a 3x in 2 years. Meta big time earnings came out. Big beat on Meta. Nah. Meta reported $10 versus $6. That's insane. Meta's ad business is going stupid. That's really what it is. I guarantee it. Meta's ad business. AMD's up 5%. Bitcoin's 75. Ethereum's at 2,200. I don't know what's up with Ethereum. It's weird. Yeah, SPY up post. Wow. Pretty good move post. Wow. Even those contracts are just worthless though. The trades were not really present today. Market, we really kind of did nothing. If you really look from the open, we kind of didn't do much. Made a few lower lows and then ended up back at right where we opened. Basically, we closed where we opened almost. Getting a gap up tomorrow. Maybe we go for a new high over 715 tomorrow. That'll be a bullish move we can take advantage of. No reason to be bearish here. We just had news that Iran's running out of oil supply, and the peace talks are still happening. The ceasefire is indefinite. So I think the market continuing to rally is highly likely. So I'll be looking at that tomorrow. Right now I'm gonna have to go get some food. I gotta go. I went to the grocery store earlier. That's why I wasn't on at 11. I was at the grocery store getting pasta sauce and bread. I'm gonna go make some pasta. And I'm gonna do some, yeah, it was good talking about Jerome Powell. I had to put a little bit of a paper together talking about the history of Jerome Powell. And I'll go ahead and probably clip it and post it on my account. So tomorrow I'm gonna be going over for the second time my $50 doctrine for this account. My account's at $103 right now, but that's because I made a 400% trade last Friday while I was in bed. I took a $12 contract and sold it for 54 cents. Kind of brought my account back, and I had already reset it by depositing 50, so now it's at 103, which is chill. So tomorrow I'm gonna go over my $50 trading doctrine, which I did last Friday. And I meant to clip it and post that. I don't know. I'd have to go through it again, see if it was good. But I'll go through it again tomorrow, and then hopefully that'll be solid. I try to finalize it there. But I have a lot of work to do right now. I got like this crazy 2-part essay I'm finishing, and then I didn't even take a trade today. It kind of sucks, but we'll see what happens. I'm going to go ahead and go do what I got to do. So have a great rest of the day. Shout out to Jerome Powell. See what happens next. I'll be back tomorrow.